894 words, within the 5% tolerance of the 900-word target. Here's the script. 1984, the United States Congress rewrote a tax law that had stood, almost untouched, for 63 years, and sealed off a door for everyone except real estate. Section 1031. A wealth tool that once let a farmer, a mechanic, a jeweler defer tax on almost anything they owned. To this day, no one in Washington has ever fully explained why real estate alone got to keep it. By the end of this, you'll understand exactly what got buried to protect it. Section 1031 lives inside the Internal Revenue Code, tucked between depreciation schedules and estate rules nobody reads for fun. It began in 1921, in the earliest days of the modern income tax, as something almost boring. If you traded one piece of property for another of the same kind, a farm for a farm, a truck for a truck, you didn't pay tax on the swap. Not because the government forgot to collect it, because Congress decided you hadn't really cashed out. For decades it worked exactly like that. Ordinary, unremarkable. A rule mechanics and ranchers and shopkeepers used without ever needing a lawyer to explain it to them. Then, in 1979, a family named Starker sued the federal government and won the right to delay their exchange, to sell first and buy later, as long as they moved fast enough. Congress didn't reverse it. In 1984, they wrote it into law. 45 days to name a replacement property, 180 days to close. And once that clock existed, something almost impossible happened. Real estate investors realized they could do it again. And again. Sell a building, defer the tax, buy another, defer it again, decade after decade, generation after generation, never once paying the capital gains bill the rest of us pay the moment we sell anything for a profit. Estate planners have a name for it. They call it swap till you drop. Because if you never sell for cash and you die still holding the property, the tax bill dies with you, legally, permanently, erased. The official story when the door finally closed for everyone but real estate was simplification. In December 2017, tucked inside a much larger tax bill, Congress rewrote Section 1031 one more time and struck out every word that didn't say real property. Overnight, the mechanic exchanging a fleet of trucks lost it. The rancher exchanging cattle lost it. The restaurant owner trading in used kitchen equipment. The collector swapping artwork, franchise owners, aircraft owners, all of it gone, in a single sentence buried on page after page of legislative text almost no one outside Washington ever read in full. Lawmakers called it a cleanup. That's the same door from the start of this, the one nobody in Washington has ever fully explained. Because cleanups don't usually spare the single largest asset class in the country, here's what makes it impossible to call an accident. Congressional analysts had already seen the numbers years earlier. One widely cited academic study put like-kind real estate exchanges at deferring more than $99 billion in capital gains in a single year alone. The real estate industry's own trade groups had commissioned studies claiming the provision supported well over 1 million jobs annually. Those studies were sitting on desks in Washington while the bill was being drafted. Meanwhile, no equivalent lobby existed for the mechanic with 3 delivery trucks or the rancher with 400 head of cattle. There was no trade association spending millions to protect the guy trading in a walk-in freezer. So when the pen came down on page after page of that bill, it came down exactly once, on everyone who didn't have a seat at the table. Real estate kept its infinite deferral machine, intact, untouched, still running today, right now, as you watch this. Everyone else got a single paragraph that ended it for good, without a hearing most Americans ever heard about, without a single news segment explaining what had just been quietly removed from the law. Today, Section 1031 still moves more real estate money through the tax code, tax-free, than almost any other rule on the books. Real estate investors, often the wealthiest ones, the ones who can already afford a tax attorney and a qualified intermediary, can still buy, sell, and defer forever. A small business owner trading a company truck cannot. A farmer swapping equipment cannot. The rule that once treated every kind of property the same now treats one asset class as untouchable and everything else as fair game. And it happened exactly the way it always happens. Not with an announcement, not with a debate the public was invited into, but with a single definitional change buried inside a 900-page bill, timed to pass right before Christmas, when almost no one outside Washington was watching the tax code at all. So ask yourself the question no committee hearing ever answered out loud. If closing the loophole for equipment, artwork, and livestock was really about fairness, why does the single most valuable asset class in America still get to swap till you drop, tax-free forever. Nobody in Washington has ever given a straight answer. And as long as that door stays open for only one kind of owner, maybe nobody ever will.